How's it going, guys? In today's video, I'm going to be going over the few things that I think have very directly caused the Bay Area housing market and a lot of other places in the United States to currently go into the buying frenzy that they're in. So, first thing is the Federal Reserve. Now, the Federal Reserve doesn't necessarily directly set the mortgage rates, but there are a few things they do in particular and did in particular when it has to do with COVID that does affect the mortgage rates. Now, one of the things that they did was that's more indirect was setting the federal fund rate, which is the cost of banks borrowing from each other overnight, down to 0 to 0.25%. 0% back in March 26 of 2020, and they kept it there for a little while, and now I believe it's up to 0.25%. What that has to do with is essentially the Federal Reserve is in charge of our monetary policy and trying to keep the economy stable, keep the dollar flowing, stuff like that. And so they tell the banks, they make it a requirement, hey, you have to keep X amount of money in your bank overnight. So for banks that have over like 120 to 160 million, can't remember the exact number, they had needed to keep like 10% in their reserves, which makes the banks less liquid, which makes it more risky for them to lend out the capital that they do have because they have 10% less capital. And then for the banks that were at like 16 to 17 million, they only had to keep like 3% on hand because obviously in these smaller towns that have less money, that have less deposits coming in that year, the Federal Reserve still wants money to be flowing there, and so they lower the requirement for them. And then for under $16 million for the small towns, they didn't have essentially any requirement. Right now, the Federal Reserve basically set the requirement at zero money that the banks need to have on hand overnight, and if they do need money to lend from each other so that they can give out more money, because the bank makes money by essentially borrowing money and then charging a slightly higher interest rate, and that slightly higher interest rate is the mortgage rate. Now, if they don't have to keep any money on hand and the money that they do borrow is super cheap, that primarily affects the AMR rates, the adjustable, or the ARM rates, the adjustable rate mortgages that are changing on a monthly or every few months. Now, the reason is because that's a more short-term thing, because the federal fund could raise the federal funds rate, the rate that the banks have to charge each other, and they could raise the reserve limits that they have to have. And so that stuff primarily kind of directly and indirectly affects the mortgages that are changing on a monthly basis. Now, where the effect comes more so for the fixed rate mortgages is the second thing that the Federal Reserve did. They bought $500 billion of US Treasury notes and bonds, and they said they were going to purchase, and they're slowly doing that now, and they said they were going to purchase $200 billion worth of mortgage-backed securities. Now, essentially what those two things do is it lowers the profitability of investors on the secondary markets of being able to go and purchase those, because increased demand for the treasury notes, which is essentially shares of the government's debt that they're selling, and increased demand for the mortgage-backed securities means that the banks and institutions that are selling those on the secondary market and packaging up all these mortgages and everything get to sell them for cheaper. So the investors are getting a lower return. But because the banks are able to then sell that and pay a lower interest rate to them, that means that now the banks have more reserves on hand. Right now, they said, the Federal Reserve said that the banks have in excess of like $200 billion in reserves. And so by the Federal Reserve purchasing all of these shares, it acts as a credit on the balance sheet of the banks. They have more reserves, and now that they have more money to spend and they don't have to keep any of that money on hand, now they can freely lend it out, and they can just charge their few percent higher. And that few percent higher, the difference in the yield rate that the banks are getting from selling these mortgage-backed securities and treasury bonds and all that in the secondary market, the difference between the percentage they're earning on that is essentially what drives the mortgage rates. So, yeah, and something to note with that is for every single recession, the Federal Reserve basically when they've lowered rates, every time they've lowered rates during a recession, they pretty much haven't raised it much for 4 years. And so even though we are going into, a kind of a quick recovery, it seems like right now, and things are going well for us because the Federal Reserve is pumping so much money into the economy, and there's all of these other policies that are going on, like the stimulus checks and stuff like that. They still said that they're not going to raise it until they're sure that inflation is staying above 2% for basically a couple years. Until they're sure that inflation is staying up, they're not going to lower those rates. Now, the problem is, and this is why it creates sort of an inverted bell curve in the long term, dropping mortgage rates but then spiking them back up, is because when you when you keep the rates low, that essentially devalues the mortgage-backed securities, because the mortgage-backed securities are based on the US dollar. So if you raise inflation by increasing the likelihood of banks to lend out money and promoting riskier behavior and promoting taking out more money, which usually drives prices up, drives inflation up, which you see very directly in the Bay Area market right now, housing prices shooting up. What that does is that devalues the dollar. And since the dollar is what the mortgage-backed securities are based on, that devalues the mortgage-backed securities, which means that in the long term, the banks actually have to raise their mortgage rates in order to compensate for that. Now, you have other factors such as supply and demand going on, but that's one of the biggest factors that has essentially, shaped the mortgage market right now, and the cost of lending and the cost of getting a home. And then also what we have is, a lot of millennials are turning 24, 25, 26, 27, 28, and they want to purchase a home right now, but they weren't able to during the beginning of COVID. So, and because there's no inventory, they're not able to purchase anything. There's 40% less homes on the market than there was last year. And that was on top of the problem we already had, which was between the 1970s to the 2010s, essentially they were building another 26 million homes every 10 years. But in the 2010s, they only built 6 million. So 20 million homes were just missing. And then at the beginning of COVID, that was right before peak buying season was supposed to start. So already all of the other people that wanted to purchase a home was already building up buying pressure from that. And then you add on the fact that now all of the millennials are turning 24, 25 and wanting to purchase. Maybe they've been at Google, and specifically in the Bay Area, maybe they've been at Google or Facebook for their 3 or 4 years, or they've been at the new tech company, or their company went public and their stocks have reached their maturation date where they're able to pull it out after 4 years, if the company offered that to them. So now all this money is coming in, and then you add on top of that the fact that there's a lot more institutional money coming into the real estate market now, especially with inflation increasing, because now essentially the institutions are like, hey, what they're able to do is they can purchase a bulk number of homes for cheaper rates than everybody else, which is just very clearly going to drive rates up. If you're able to get stuff cheaper than everybody else and you can buy it in bulk, and then they're just going to rent out those units. So you have all this institutional money coming in, you have the Federal Reserve playing with their rates basically and dropping them in the short term. Usually they don't as directly affect the rates as some people might think, but for COVID they did, because of all of the mortgage-backed securities they purchased, making it easier for the banks to lend, or by increasing their reserves on hand. Yeah. And then, let's see. Yeah, that's about it. I mean, so there's all those things, and then what a few other people were talking about is, the cost of lumber and stuff like that, and then obviously, alongside that, you have all of the other construction materials that are being increasingly difficult to get as these countries are dealing with COVID and trying to go through that. So, if they're not able, and then all the tariffs on the other countries that we have and everything. So yeah, there's a lot of stuff affecting the Bay Area housing market. Some of it is going to be directly affected by the Federal Reserve. Some of it is going to be, based on the audience that real estate has. In the 2000s, that's when HGTV, Property Brothers, Fix or Flip, all of these TV shows came out. Because before that, people fixing and flipping properties used to just be essentially real estate agents and maybe mortgage brokers, and that was about it. But because of all of these TV shows, it's made real estate more and more so a popular investment, and this kind of dream of like, oh, maybe I can go make a bunch of money with it. So there's some aspects like that that are drawing money in, and then you have the fact that there's not enough homes that were built, lumber prices are going up, there's a lot of stuff going on. And I think what's going to happen is that we have 20% more home starts this year. So the developers are aware of the issue that there's not enough homes. What the Federal Reserve and what everybody wants to do is essentially, we're growing kind of too quick right now. We need developers to go and build a bunch of properties. That way it'll alleviate some of the buying pressure. Will they be able to build it quick enough? And will that one factor be able to help the entire market grow at a slower rate? Maybe, maybe not. But we'll see. Let me know what you guys think down in the comments, and remember to like, comment, subscribe. I'll see you next time.